I've had a lot of requests for revealing my methods for analyzing semiconductor companies, and this is an attempt to show what I'm up to. It's not smooth and professional. It's just the way I do analysis is it's driven by curiosity, and sometimes I find something. Other times I don't find something, but I'm always looking for something. So my aim is not really to try and predict the next quarter or the near-term, stock fluctuations. That is the job of the analysts, and they spend an exorbitant amount of time on trying to question the CEO about the near-term situation, so they can give a good guidance and give their clients some, idea of where the stock might be moving short-term. But I view it a little bit different. So, you look at TSMC's revenue here, you can see that there's the new guidance here is reasonably good guidance for other companies. We're up about 8%, 38% year over year. I think most companies would be willing to kill for that, but this is TSMC, so the standards are different. But the reality is that if you move back, let's say 5 or 6 years and looked at TSMC down here, and then you're wasting your time trying to predict, the second quarter of 19, it gives you no real idea of where the company is headed. Or maybe you can make, a few bucks on some stock swings. But the reality is you need to understand, or you don't need to, but if I were investing or just depending on the semiconductor industry, I would like to understand what is happening a little bit longer term. And that is always the aim of what I do. I try and find out what's going on below the numbers, and not just being satisfied by the immediate result. But of course, that's where most of my analysis start. It always starts with revenue and guidance. Get a good feel for what's going on. For the analyst, it's quite important that the company meet their guidance. But the reality is that when a company meets their guidance, it's because they're controlling the revenue. And when they're controlling the revenue, that also means that they're not optimizing revenue. That really means that they got the brakes on in order for them to hit the number. And if I were an investor, I wouldn't think that was a very healthy thing to do. I'd like the company to go, all guns blazing and trying to make a great result and not put on the brakes when they were close to guidance. But that's the reality. When a company hits guidance, it's because they're in control. That also goes for TSMC, but of course they have sort of like a longer term horizon. So when they have activities, revenue generating activities, they're typically 6 to 8 quarters out. So I'm not so worried about TSMC, maybe more worried about other companies. But for the analysts, they spend a lot of energy on this. I normally say it's like, if in school I'd said, hey, I met my own expectations, that's not the same as getting a good grade, okay? And this is basically what's happening here. The company sets the expectations, and then if they meet the expectations, you hear them say, we were slightly above our guidance, and then they expect to get praised. This is a little bit silly, but that's just me. But let's take a look at TSMC right now. The result was good. And we could see here with the quarterly growth that we are in around, everything is huddling around the 20s. So you got gross operating and net profits here, plus revenue. Revenue's tucked in a little bit here on the back. But what you could see, it's pretty close around the 20. So there's, it's typically, for me, it's saying, okay, it's business as usual, nothing to see here. Up here you can see there's some other things going on. Revenue is a relatively high 45, but you could also see that gross up and net are higher. For TSMC, we know what goes on. It's basically more and more revenue are moving to the 3-nanometer node, which is incredibly healthy from a margin perspective for TSMC. So you could see the development here. But all in all, there's not a lot of surprises in the TSMC revenue chart here or the profit charts. Let's move on a little bit and go to the outlook. So as the analyst quickly found out, was that if you added the annual outlook for TSMC to their models, they could see that Q4 would be down, and that's a little bit interesting because Q4 is normally what I would call Apple quarter. And that is the quarter where Apple consumes the most products. Actually, interestingly, Apple sells in Q4. They also manufacture in Q4, and they also get their chips in Q4, which is it's pretty amazing. You'd normally think that there was a little bit of a delay. But, whatever criticism Cook is getting, it's not for his manufacturing strategy. It's incredibly tight and well organized. But that also causes a small problem for Q4 guidance. As you could see, that's down, and it really should be up in that quarter because of the consumer revenue from Apple. So it's going to be interesting to find out what goes on. We weren't really given any good reason, but of course, most likely is something to do with the high performance computing and some of the smaller nodes. It might not be anything to worry about. I'm not super worried, but it's just a hole in the data that we have right now that I'll probably look into at a later stage. If we look at the margins percentage-wise, there's not a lot going on here. You could see that the gross margin is going down slightly, and I want to dig into that a little bit more because that's quite interesting for TSMC. There's a lot of information in their gross margin. So here you see the gross margin growth together with the gross profit growth together with the gross margin. And as you could see here, it goes down very, very slightly. You would also see here that there's a long-term guidance of 53%. So of course, the analysts attacked a little bit to, they want to know again. I don't know why the analysts have to upsell. But the analysts always want, people to commit to a higher number. As an analyst, you should not touch. You should not touch the data source. Let them say whatever they want to say, and don't try and pump it. But these, especially the sell-side analysts, are very busy trying to encourage the CEO to give a higher number. Give some happy news that they can bring to their clients. Yeah. If you prefer one outcome or another, you're not an analyst. That's one thing that's sure. I might be tempted, and I am. I like when things change, but I know that I need to stay out of it. It's just not the right way of doing an analysis. You got to be, completely. It has to be irrelevant if it goes up or down and stays flat. That's not for you to decide. Find out what's going on instead. But the reality is that they have a long-term goal of 53%, and then they're higher right now, about 59%. So let's try and go in and have a look at what is impacting the gross margin at the moment. And here, I've carried over the gross margin percentage and the corporate long-term goal here. And then we can see there was some of the headwinds that were in this quarter. First of all, there was a currency impact. So the new Taiwan dollar basically appreciated against the US dollar. it was about 31 before the quarter started, and then 29 in the quarter. And that impacts TSMC's both revenue and gross profit. For every 1% of appreciation, it's 1% of revenue, as almost all of TSMC's revenue is in US dollar. And from a gross margin perspective, it's about 40 basis points, as 75% of TSMC's costs are in new Taiwanese dollars. So as you could see here, there was about a 40 basis point headwind on the gross margins in this quarter. There were also some positives. There were some cost savings, and there were a higher utilization rate that I'm going to cover a little bit later. But what is a little bit more interesting is that TSMC gives us an idea of what it costs to operate in other countries. So basically right now they're talking about Japan and Arizona, with Arizona being having the biggest impact. And as you could see right now, the negative impact on gross margin is about 100 basis points. And that means that we have a scenario where, it might be a very, very good idea for TSMC to construct capacity in the US for other reasons. I know the main reason is not to please the US administration. That's an added benefit. The true reason is that both Apple and NVIDIA are very interested in getting manufacturing on US soil, so they can appease the US administration and probably future administrations as well. But the reality for TSMC is that they follow their clients. If they want that, okay, they'll get that. But it is more expensive for TSMC to produce in the US. Right now, it costs them, 1% of their margin. More interestingly is the future. So as you could see, when we go into the medium-term impact, the overseas operation goes from 100 basis point negative impact to 2.5 or 250 basis points. And eventually, long-term, it'll be about 350 basis points. And that sort of brings the gross profit margin down, not at the 53% level, but close to. So this is sort of the rationale behind having a 53% long-term gross profit margin target, and then right now running at 59. This is quite important. When you look at the plant capacity that TSMC is building in the US, they right now have a plan about 6 wafer fabs and 2 advanced packaging plants, 8 in total. And that sounds like a lot of capacity, and it is. But at the same time, TSMC is building about 15 plants at home to offset this cost. So it's not like you think with all of the noise that the US is going to be the manufacturing hub of the world soon. It is not. It's going to take a lot of time, and it's not really going to move the needle much in terms of Taiwan, maybe in terms of other places in the world. But when it's fully constructed with the current plans, TSMC expects that about 30% of their leading edge capacity will be in the US. And I read that as probably 2 nanometer when everything is fully rolled out. But once again, there's a lot of interesting information in a flat line, basically, on gross margin. But it gives us a lot of insight into the business. Turning to operational expenses, it can be seen that TSMC is most certainly not a popcorn outfit. The total OpEx is now closing in on $2.8 billion per quarter. And as can be seen here, it's about 2 of those that are R&D. So it's a sizable R&D budget. The trend, however, from a share of revenue perspective is going down. Both here you can see R&D from 0.8 to 7.5, and SG&A from 3.5 down to 2-ish, 2-6, something like that. And this is maybe surprising, but on the other hand, we see that TSMC is incredibly good at using its scale efficiently. And they're also doing it here. Of course, you have to see that in light of what's going on in, can you say, the foundry in general. And that you can see here. Here we plotted SG&A down here in percentage, and up here R&D in percentage. As you can see here, the TSMC is not at all in front relative to their size. Actually, they're probably one of the more efficient companies. Here we got data from 21 Q1. We can try and move this forward. Let's go. There we are, Q2. And just take Q1, Q2. There was some movement. But here we see Q1, most of the companies have reported there. And TSMC is actually the smallest, or has relatively the smallest SG&A and smallest R&D budget. Again, here shows how the Taiwanese are extremely good at leveraging their scale and to get a lot of juice out of their OpEx. Turning to CapEx, there's a few things that's worth noting when talking about TSMC CapEx. That is, compared to other companies, TSMC are probably more customer-focused. Other corporations have a tendency to make a long-term plan and then follow that and then hopefully start selling some stuff. But for TSMC, it's actually the reverse. They have quite a good grip on their customers. They have long-term deals, and they build the capacity according to customer input. So what we're seeing here is probably a reflection of what they expect their customer demand to be within a year to a year and a half. Interesting here, and everywhere else in the industry, you could see that right after the CHIPS Act were implemented in Q3 22, basically investments dropped. Like everybody else, TSMC had to adjust their plans to make a maximum utilization of the subsidies and took a break. And as you can see on PPE, from that point on, of course, PPE didn't get fed, so equipment depreciated. It got below what's called the maintenance level of investment, and that basically means that you're, at least in financial terms, the value of your manufacturing is actually going down. It doesn't always have a practical implication in the short term. TSMC could probably run the same wafers through, but over time, it has to follow. You have to be above the maintenance level in order to keep your property, plant, and equipment at a reasonable level, and that does equate to capacity over time. What we can also see is that there's a new, regime now from fourth quarter 24, and that's also starting to have an impact on the PPE. The current level was of about 10 billion a quarter, was reiterated at coal with a bracket of 2 billion plus minus. And there were some statements about the long-term capex. C.C. Wei said that it's probably not going to fall, at any dramatic level over the next period of time. But he also said that he expected capex to grow at a lower level than revenue. again, here we see that operational efficiency is deeply ingrained into TSMC, and they're trying to optimize over time. That goes for capex also. Here we are seeing TSMC's revenue by markets or customers in the market, and of course, apart from the very obvious rise of high-performance computing, we'd also see that traditionally the smartphone market has been quite strong for TSMC, and it's also what is causing the seasonality in TSMC's numbers. On the right-hand side here, we got smartphone revenue, and as you could see, there are clear peaks in Q4. Of course, closely associated with Apple's revenue peaks and also cost of goods sold peaks. So those basically rolled through into the TSMC numbers. What I normally do is I put in the seasonality as a band. So from last year, when you move from Q1 to Q2, the band was negative. But as you could see here, moving from Q1 to Q2, the band is positive. So that means that this is basically not anymore impacted on the seasonality. And it's an interesting question. There were some information. It looks like there was some stimulus by the Chinese government into the smartphone market that gave TSMC an upside. Something that also can be seen in the revenue by country, where there was an uptick in Chinese numbers. So in all likelihood, what we're seeing here is the effect of that activity. So we're about halfway through my analysis, and it is what I would call the standard analysis, high level. This is also what is normally free on my blog whenever I do analysis of companies and company results. I also do cross-sector analysis, and it's basically the same. You have the high-level analysis is for free, and then I take a deeper dive into the real juicy stuff. And I wanted to leave you with one slide from one dashboard from the advanced analysis, because I find that incredibly interesting. So this is basically TSMC's capacity and shipments, and they're measured in 12-inch equivalent wafers. So it's basically silicon area that it's measured in. And as you could see from the left-hand side here, the orange, we go back to the beginning of 19. TSMC could manufacture about 3 million wafers per quarter. That is now about 50% higher, in the range of 4.5 million. What is interesting is in this period where the number of wafer capacity has grown by 50%, TSMC revenue have grown by 4.5x. It tells you a story about efficiency and how these incredibly expensive wafers are making TSMC an incredibly successful company, and with only very few wafers that makes a difference. What you can see here is that in the last upcycle, TSMC was running at 100%. You see that the utilization rate here dropped down quite a lot. And here you see basically the AI revolution started here, and see how much effort that required from TSMC. Not a lot, okay? And last quarter, we were looking at 73% utilization rate, which is incredibly low, given that we are now 2 years into the upcycle. Again, utilization rate overall is one thing, and then there are what's going on at the advanced nodes. And there's no doubt that the 5 nanometer and the 3 nanometer is incredibly tight right now. And will be so for the next 2 to 3 years, despite 2 nanometers coming on board. It's actually so tight that TSMC is trying to convert 7 nanometer, which is plentiful, to 5 and 5 to 3. And normally you don't do that on, normally a production line stays the nanometers it was born with, but TSMC have about 70 to 80% similarity in their equipment, so they have the opportunity to do so. What is also quite interesting is this uptick that you see over here. It's about 10% in capacity that increased in a quarter. So we don't know the full story. I think that there's certainly an upside from the Chinese from a smartphone perspective. You could think that it was H20 from NVIDIA that were back on, but C.C. Wei were asked about this and actually said that he'd heard nothing from NVIDIA about, can you say, remanufacturing H20 for the Chinese market. So there's no news there. There might be some other interesting things that we will uncover during the quarter, and maybe we will find something in other results that we see over the next few weeks. So I hope you have enjoyed this very raw and unfiltered podcast. It probably is, where I'm desperately trying to think and speak at the same time. But there was a lot of interest in how I do things, and maybe interest in seeing some of the underlying data and dashboards that I use. So hopefully, if you liked it, give me a like on LinkedIn, and subscribe to my blog if you find this interesting. Thank you very much.